Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Hello and welcome to the Liquidity Event. I'm your host, Shane Mason.
And I'm AJ Ayers.
And this is episode 148, being recorded on May 28th, 2025, airing on May 30th. A quick reminder for you listeners, we will answer your questions live on the pod. Well, not live. On the pod, if you leave us a message, you can disguise your voice and use a fake name if you're shy about it. The Liquidity Event link is at memo.fm/the liquidity event. On today's episode, we do have some cash crunch hitting the elite university endowments. Turns out that the VC firms aren't writing checks like they used to. Then we're going to meet the new sheriff in town, the VC portfolio pruner, here to chop deadweight startups off the portfolio. And finally, startup employees are selling their stock like it's 1999 because no one knows when the IPO gods will smile again. AJ, how are we doing today?
I am doing great. I'm excited. We have some real meat on the bone, as it were, in today's episode. Last week, while you were in Scotland, we had Peter and Rubin on the pod, and they were roasting you and I for not talking about anything for the first 15 minutes of the show before we actually get to any articles. Today, we've got three themed articles, folks. We're going to talk about some real meat. We're going to talk about the IPO market. We're going to talk about the state of VC. We're going to talk about the state of college endowments. We are going to solve world hunger right here on the Liquidity Event podcast.
I'm going to have to do a hard disagree on their take. I think people show up. I listen to podcasts not only for the content, but also I like the people that I'm listening to. I can get content from anywhere in the world, but I choose to have it filtered through people that I want to keep up with their lives. So, I don't know, Rubin. I don't know, Peter. Maybe get your own fucking podcasts. AJ, you went to a play recently? I know they have their own podcast. You went to a play last week,
yes, I did. Last night, my husband and I went to see...
Speaking of Scotland,
my husband and I went to see Glen Ross on Broadway with so many celebrities. I could not even count this. Every time this new person popped up on stage, I was like, holy shit, that's so-and-so. But the main celebrities are Bob Odenkirk and Kieran Culkin. So it was really cool to see them. It's a neat little play. It's only an hour and 30 minutes plus an intermission. And I really enjoyed, I just love going to theater. If you live in New York City and you're paying, 15% state taxes to live here, you might as well go enjoy the cultural things that it has to offer, which is my current feeling. So what's interesting though, you've seen Glen Ross, and like the famous line is like, "Coffee's for closers." That's the thing that most people remember from that movie.
Of course.
Incidentally, that line is not, I guess, in the original script play by David Mamet, so it actually wasn't in the play I saw last night. I was like waiting for the "coffee for closers" line. In fact, I bought John Owens, our managing partner, a mug that says "coffee for closers" because it's our little inside joke. But they don't actually say that line in the play. Fun fact for y'all.
Yeah, but they say it in the movie, so
right, but
what are we doing?
Anyway.
So Alec Baldwin wasn't there?
Alec Baldwin was not there. But I was trying to think if he's been in a movie opposite Kieran Culkin, and I can't think of anything.
That's cool.
But I did come home and watch 30 Rock, so I got my Alec Baldwin dose yesterday.
Nice. 30 Rock. One of those shows that I definitely need to watch, but have not made it down the list yet. All right. Well, Scotland was cool. Thanks for asking. Anyway,
I was about to say, where are you? It looks like we have a new background here.
I'm in Ireland today. I'm in my one of my dearest, closest friend's house that he built. He's a home builder and a bit of an Irish celebrity. He has a TV show out here where he builds homes, but most importantly, he teaches people how to build their own homes. Cool. So he's really strong and handsome. He's on TV. You know Harry.
I do.
He might be listening to this episode.
I'm a big fan of Harry.
You should listen to this episode.
You should.
Yeah.
You're having a great time with your homie. I love that for you.
Yeah, we did some clay pigeon shooting out in Scotland, and we did some kayaking, and we ate some scotch eggs and haggis. Lovely, lovely stuff.
like a scotch egg.
Haggis underrated, I gotta say. It's very much a dude meal. It's like what I make when I don't have anything, when I cook. It's like I've got four ingredients: black beans, chicken, rice, and just diced onions,
And
like
hot
minced
sauce, and a
meat.
lot of hot sauce. Douse
Yeah.
the whole thing in hot sauce.
I mean, that's a given. Does that count as an ingredient if it's in every dish? Do you count the
sure.
plate if it's
Do you put hot
cool?
sauce on your cereal? So it's not in
I've
every
probably
dish.
done it.
Ugh.
Yeah, that's kind of gross.
Gross.
But I do
Anyways,
can work in dairy. Anyway, moving on.
what do we
To
got?
take some notes from our boys, Peter and Rubin. Rubin looks really good on a BK5 hat, I must say, by the way. So shout out
know.
to Rubin. We've got three articles from the same publication today, all about the general state of venture capital, private equity, startup employees, and founders, and some of the challenges that they're facing, and endowments, the people that potentially are funding the education for a lot of these startup founders, the endowments at various institutions. Turns out that both your institution of learning, Skidmore, and my institution of learning also have endowments. You don't really hear about it very often. You really just tend to hear about the big ones, like the ones at Yale, run by David Swensen, and the ones at Harvard, which are challenged by Trump lately, in the news a lot lately. A lot of theories on why that is. AJ, why do you think Trump's messing with Harvard so much?
Because Obama went there and he's jealous and he doesn't, he hates everything that any president that isn't him experienced. That's my
Yeah.
theory.
A lot of people have theorized that Barron did not get in
Oh,
to
okay.
Harvard,
Also,
and
Or he like
six,
doesn't like the
seven.
color red, like maroon or something. I don't know. It's probably some stupid, stupid reason. I guess he likes the color red, but maybe maroon is too close to red. His MAGA color. Anyway, right. So
Barron's grades must be really bad considering George Bush Jr. got into Harvard. But yeah,
but like we're gonna.
so
Oh, go ahead.
no, you got it.
I was gonna say these articles, all from The Information, by the way. If you want to keep up with tech news, that's where I get all my tech news. Not sponsored by The Information, I just like them. I've been thinking a lot about the IPO market, and like, there's a lot of things we're talking about today. We're talking about college endowments. We're talking about employees who are trying to get liquidity. We're talking about founders who are trying to have exits. We're talking about VCs who are trying to have exits. We're talking about private equity. All these different parts of the ecosystem of the markets are being blocked, and I'm imagining it like a pipe in your basement. Have you seen those like videos on TikTok where it's like a plumber like going in and like getting like this like nasty like hairball out of the pipes, and then all the water gushing through? So like I'm hoping some plumber, aka the markets, someone will be brave enough to go public. It might be Chime, which is happening soon, will go public, have a successful IPO, and everyone will stop being such a freaking fraidy cat and actually take their companies public, because we need to unlock some of this liquidity. It's currently being blocked by this giant hairball. So that's what I got from all these articles.
Wait, what's the hairball?
The hairball is the IPO market.
Is it?
It's just blocked. It's all of these founders being advised by these investment bankers not to go public because the market's not kind. That's like the hairball. And so we need a Drano.
Who's the cat?
There's no cat.
Who's the cat?
There's no cat. No, it's not a cat. It's my hair. There's no cat involved. It's 10 years of my long hair getting stuck in the bathtub drain, blocking up the pipes. And so we need to pour Drano, aka one successful IPO, which might be Chime in a couple weeks, down the drain to unstuck the ball of hair and crap and toothpaste and dental floss and whatever else we put down the drain. And then we'll clear out the pipes, and we can have some exits for employees and VCs and private equity and these endowments, which rely on all of those.
Yeah. I've heard alternative ways to to clear the pipes is that there are currently not a ton of great growth within the private space. There's just as good a growth within the Google and the Metas of public companies. So why deal with the risk of a totally new startup that we would want to grow to 20-25% when we already have these current operating monopolies, such as Google, offering monopoly-like returns, right? So why even mess with a startup? Why invest in one? Or like why put valuations high enough that would incentivize these people to deal with all of the trouble of going public? And we can see Stripe hasn't gone public. We can see a lot of these private companies, and plus there's tons of liquidity in the private markets Anyway,
For sure.
so let's pop it like with that in mind, with those items in mind, and AJ's delicious metaphor.
Quick point
Let's
there.
take a look at some of these.
Well, like
Yeah, go for it.
speaking of just like changing the landscape of exits, like as you mentioned, yeah, if Google's doing amazing, Meta's doing amazing, like these are huge companies who have monopolies basically on parts of things that the technology that we use, right? So if you're a little baby startup and you want to have an exit in a few years, chances are right now in the current landscape, it's not going to be an IPO. It's probably going to be an acquisition. Like famously, Mark Zuckerberg is like, let's kill Instagram, let's kill Snapchat, let's build it ourselves or buy it. It's like, what is it, buy or kill? I forget the exact phrasing. So I think we're going to see a lot more of that. We're going to see a lot more acquisitions by the Googles and Metas and open AIs of the world, rather than
It's actually
IPOs.
it's fuck, kill, marry. Actually, are the three choices that you have for the startups
For the exit,
that are, attempting to.
For a little
Saw
liquidity.
a great meme the other day that was like, somebody's like, do you ever wonder how many times you've been the kill, or are you normal? Anyway, so let's
What
get
do
into
you
let's
think
start
you
the
are?
article.
What do you
Sure.
think you are?
I don't know. I'd like to think I'm not a kill. I think I think I get along with people. That's not good. That's not a good sign.
I got news for you, bud. You aren't either of those.
Aw, bummer.
Sorry, mate.
I'm a kill. Well, who are the other two?
Doesn't
Who am I up
matter.
against? No, of course it matters. Me, Hitler, and Lincoln? I'm definitely not a
Nope,
kill in
doesn't
that
change my
scenario.
answer.
Aw, you would marry. I know. All right. Anyway, moving on. Let's. This has gone completely off the rails here. We're doing fuck, kill, marry.
Never at the Liquidity Event do we go off the rails. But speaking of going off the rails, Trump has gone off the rails and threatened to cancel Harvard's funding to Harvard that was previously promised. So what is Harvard going to have to do? It is going to have to reach into its own $50 billion endowment. It needs cash, right? It needs liquidity, and that's what we're talking about here. The hairball is stuck. They can't get liquidity. So you had a bunch of points in this article, Shane. Tell me about what's going on at these big endowments and how do we get some cash?
Yeah. So within the endowment space, we have this article: endowments need cash, but VC firms have none to offer. This was kind of insightful for me. I didn't really realize how much. How big the relationship was between VC firms and endowments, but it makes sense considering the size of the checks that need to be written. Endowments are some of the largest stockpiles or pools of cash in the world. Harvard's famously $86 billion endowment. Like, what do you move money in when you're investing 10, 20, $30 billion at a time? That's the size of public companies, right? I think Chime is looking to go public at a $6 billion valuation, which means that Chime in total would be less than, 10%. It would be like not a large allocation for the total Harvard endowment, right? So anyway, so Harvard and these VCs, these endowments have invested quite a bit into these VC funds. However, there haven't been any IPOs in order to allow for the VC firms to return the cash to the investors. So these endowments, they use these returns on these investments to fund the educations that are provided to their students. It's not just federal funding and tuition that provides the cash flow to these institutions to run their organizations. They need cash from their investments that they make. And these endowments are really interesting. AJ, tell us about like some of the nature of them and like how do they operate? Are they taxed? Like, does every university have an endowment? Like, what is the role that they play? Do you have anything there for us?
Yeah, I mean, that's a good point. It's like these universities need a ton of money, and they, think of it like a personal investor. Like if you're a human and you are going to live to be about 80 years old, you need certain amounts of money at different times to do different things. You need liquidity at a certain point to buy a house. Maybe you need some money to send your kids to school. So like these endowments work in a similar way where there's a lot of needs pulling at this cash. And yes, Harvard and Yale famously have some of the largest, I think Harvard's is the largest, whereas good old Skidmore or Ole Miss probably have, I don't know what, multi-million-dollar endowments.
I looked it up.
How big is, how's the,
Of course I looked it up.
Tell me.
Constant dick measuring between you and I.
Tell me.
30% of our relationship. Well, what do you think? What do you think it is? Who's bigger?
Oh my God, I have no idea. Not Skidmore. Skidmore's a tiny little liberal arts school.
Yeah, right?
Yeah.
Yeah, but it is a private school, so I thought that they might have a larger endowment like Harvard would. But they're both sub $1 billion. there's some like takeaways here that are really important. University of Mississippi has an $836 million endowment. Skidmore has a drumroll $429 million endowment.
Okay.
Which is really interesting. That's pretty big. It's half a billion.
Yeah.
And if you're looking at like how much they need to operate, if you're getting 5% on $1 billion, that's 50 like per year. That's $50 million per year that you get to put if you invest all of that.
But that's not a lot of money.
Capital.
$50 million to run a huge institution feels like nothing. I mean, if you need to build a new science center, that's $50 million, $100 million. Like that's why these universities. Yes, you're looking and you're going, oh my God, they have $1 billion. Why are they asking me for money all the time? Well, if they need a new science center, like that's got to come from a private donor. Funny side note, just to compare Skidmore to Harvard. So I am going to my college reunion this weekend at Skidmore. So I'm actually making the drive up to ye old Skidmore College. And I was just laughing at the emails that I'm getting from the alumni council. It's like, don't forget your packing list. Don't forget to bring your toothbrush. And I'm like, you guys, what are we doing here? I actually took a screenshot and sent it to my friend who went to Harvard just to be like, look what we get for our non-Harvard
Yeah, they didn't teach you how to use your toothbrush?
They did not. They definitely did not. They didn't teach me anything about the stock market taxes or how to pack for an event as an adult, apparently.
Was the reminder list an iambic pentameter?
I think it might have been.
That's
Okay, so
the vibe.
all right, let's get back on the rails here. So I think we're done talking about this, right? Big endowment. Oh, you asked me what are they made up of, right? So how are they taxed? So they're taxed at what, 1.25%?
1.2.
1.2?
Yeah.
Yeah. So should we be taxing these institutions? I don't know. I mean, look, Shane, I think Scott Galloway talks a lot about how some of these endowments are so big that, like, come on, like Harvard could make its tuition free for its entire freshman class every year. Or more importantly, it could expand its freshman class so more people get access to the fantastic education and the community and the network that you get at Harvard. So there's a lot of arguments to say, like, hey, we should spend more of this. We shouldn't have something so big. Let's make it, I don't know, 10 or 20 billion, which should float us for a while. But this liquidity crisis is, I don't know, in my opinion, a further reason to keep these endowments as big as they are. Thoughts?
Yeah, I mean, just some quick math. If they make 5%, the endowment makes 5%. That's $4.3 billion a year of investable.
Yeah.
Of investments
Of cash
for
flow,
Harvard.
yeah.
So, yeah, I mean, Jesus Christ. And they're just not using all of that. And that's why they're pushing for taxation. It looks like Trump admin has proposed a 21% endowment tax, which would incentivize them to spend the money, right? Kind of like an estate tax or a wealth tax.
Sure.
I imagine I haven't really looked under the hood on that, but that would be, like $10 billion of taxation just from Harvard each year, which is really interesting. I think, one of the problems in America is pooled capital. A lot of capital has been pooled in specific places that isn't being distributed or moved around. I'm not when it comes to capitalism, I think one of the best ways to make it work for everyone is to make sure that the money keeps moving, right? We get investments, there's return on those investments, it gets distributed to the middle class. So I'm down with that taxation and anything that incentivizes the spending of it. One other thing I wanted to touch on this article, which I thought was really interesting, our listeners. Yeah, go ahead.
Point there. Just if we're going to tax endowments, we should also tax individuals that have net worth of more than $50 billion. Just saying. If you're going to tax a Harvard endowment, just saying.
I'm not sure if you touched on this last episode, but 2 episodes you had a live on the pod suggestion for a tax proposal. Do you have another one available?
I'm working on it. Yeah, I think if you're
throw one out?
Yeah, let's throw it out. If you've got net worth of more than $50 billion, I think and let's include endowments in this, I think we should be taxing your gains at, I don't know, I haven't decided. Let's call it 30%. But I don't think you should tax the whole pot. I don't think that is productive. I think that's counterproductive. But anything that we need to sell to fund our institution, I think we should be taxing. That one's still in the woodshed. I want to come back to that.
Yeah, I got a little distracted. There's a giant spider right above me, right?
Oh no! Abort. By the way, if we were switched, the podcast would have just been over.
It's just over.
Dear listener, I hate spiders so much.
Yeah.
In fact, I often have waking nightmares about them and also sleeping nightmares. All right, let's move
Good
on to
thing I'm not
something else.
sleeping like 3 feet away from me. The last point I wanted to touch on here was the returns from VC, like from venture capital.
Mm-hmm.
Apparently, there is a benchmark for VC firms, which, of course, any benchmark for private investment is going to have some sort of survivorship bias or self-reporting bias, wherein people only are going to report to the benchmarks if they're having a good time or they're doing a good job. But apparently, Hamilton Lane does benchmark VC firms. I just wanted to touch on some of the deltas between the historical returns. Apparently, since the year 2000, VC firms as an asset class have returned 18% on average, which is wild to me. I'm sure the volatility is all over the place. But over the last 3 years, they've only returned 8%, right? So when you get to move such large piles of cash, you get to be a market maker and you really get to not just become a passive investor. So I imagine that 18% is largely a aspect of the size of the investments that they've been able to make. Private equity has been beating them out over the last 3 to 5 years. So it's just like, I'm sorry, the richest are not really getting the returns that they are used to getting. But tiny violin for them. Okay, like you said, let's move on to the next article here. We have, speaking of cash crunches and liquidity issues, the information also has an article. This one's a lot shorter about the portfolio pruners, the people that will be looking at the portfolio of companies within the VC firms and actually doing the work of trying to figure out where they need to be sold off to if they're not going to go public. AJ, I think a big part of this lack of liquidity and this issue that we're having is that these companies can't go public, be it because the valuations are lower than they were the last time they raised, and which signals not such a green light to the investors, the retail investors that are looking at an IPO market, that we were going to need to look for another place to sell off these companies. And this article is talking about people at these companies, at these VC firms, that are now quietly shopping out these portfolio companies to potential buyers, potential M&A acquirers. What are your thoughts on the article?
I just wanted to read a quote from the article to kind of sum it up, which I loved at the end, which is, "It's a little bit of a game of go fish. Do you have a two of hearts?" He said. "You do some matchmaking and exploration." So basically it's like horse trading, right? It's like, well, hey, my portfolio, I've got, this, I think they called it, like, I've got this zombie AI company and like this travel website that no one wants. Like, what do you got over there? You have a private equity auto parts roll up situation. Can we trade? Like, can we move some things around, make it look like we're actually making movements and we're actually making changes in our portfolio and hopefully generating or promising to generate return for our investors, but actually we're just like moving the losers around. By the way, Go Fish, underrated game, underrated card game. One of my favorites.
Yeah, let's get some Go Fish going at the Brooklynify retreat
Yeah.
in a couple
And some
months. I would
war.
like to play some.
I love war.
Yeah, Loser drinks some Founders Edition single malt scotch, just as is tradition at our retreats. Yeah, my take on the article is a few things. I think that this article, it heavily features this guy Ronan Kennedy at this firm that Edward Saverin, formerly of Facebook, one of the co-founders, that famously sued Mark and got a ton of money and revoked his U.S. citizenship before moving abroad. What a fucking
Such a move. Such a move.
Yeah, for listeners that don't know this, you can escape worldwide taxation on your income. You just have to revoke your U.S. citizenship, which any of us can do, which I find very interesting. I don't know I think you need to have a landing citizenship to sport because you can't be citizenshipless, I think. I don't know. But what a vibe. He now has a VC firm that still benefits from location in the United States. Including this B fund. And anyway, this guy, Ronan Kennedy, works there. And I just looked at this guy's LinkedIn. He's quoted heavily in this. And this is such an impressive person. He was on the front lines of Iraq for 7 or 8 years, was a captain in the 101st Airborne before going to Goldman Sachs, and now works with Edward Saverin. Yeah, worked at JP Morgan. Like, is it one of those guys like I would have trouble hanging out with because I'm so impressed by them and like scared of?
The surviving something like that and being a leader during a time of war and great unrest and like coming back and being like, I'm gonna work in capital markets. Like, right. Cool. Yeah. Like, where can I add the most value here? But yeah, very impressed. Yeah. Oh, always impressed. Speaking of which, we just celebrated Memorial Day, so I'm just shout out to those who have served.
Yeah, thank you for your service, including members of both of our families.
Yep.
Yeah, like with that said, I think that the point of this article was really just like to broadcast that they are selling companies at at this firm, at this VC firm, like, why else would they allow Ronan to go out there and be like, yeah, I am in charge of selling our portfolio companies. I am the pruner at this firm, right? Like, because supposedly, like, what's the undertone of this article is that founders that have been, Series A, Series B, Series C, they have grown so much, and they think they're on the way to IPO and like $1 billion payout. They don't want a for sale sign hanging off the front of their firm, right? That would scare off potential recruits, the talent that might come to their firm. There's just like a bunch of reasons why you wouldn't want the for sale sign being on your door. So you really want to be subtle when it comes to shopping out these companies, and you're looking for synergies of potential other acquiring firms. And Ronan goes out and he just smoozes at conferences with corporate development firms.
You need a portfolio pruner. I'm gonna go in there.
But look, like,
wait, that's like a plot line in a show where like someone's like gardener like goes in the middle of the night and like prunes the hedges in like a funny dick shape or something. Anyway, I'll remember it next time.
Thanks for that. Yeah. Save it for the next episode. Or maybe while I kick out a couple more quick facts.
Okay,
you can,
please hit me with the real facts.
Yeah. Yeah. Well, I just saw like some fun takeaways from the article. Apparently 52% of the VC-backed firms that were acquired in the past had only raised seed funding, AJ, which I think is really, really wild. Like, I think like what they're trying to say is if you go Series A, B, C, those portfolio companies or the VC firms that are holding those companies or invested in them are really holding out
for an IPO.
Or it's just really, it's a lot harder to sell those companies as well because the valuation has a high watermark that everyone's kind of anchored to. And there's like, they call it valuation baggage, right? Because in 2021, if you raised at a 30 times revenues multiple, and the next time you're going to raise, it's going to be at like a 7 or 8. Yeah. And you might have like stalled out, and like doing a down round is just kind of spooky.
Let's make the down round great again. Sometimes you got to recalibrate.
Make the down round great again.
Sometimes you got to recalibrate. Sometimes you got to go, oops, we thought this was going to work out. Another competitor entered the space. So we're going to have a down round. Sorry about that, folks, but we're going to get back on track. And we've got a 5-year IPO plan once we get some capital back some gas in the tank, and let's go for it.
Yeah, have fun explaining that to engineers, famously easily to communicate with about financing.
Your stock options are worth less. Please come work here.
They're worthless or worth less?
Worth less. Right. Worth less. Worth less.
Right. So easy to discuss that.
One more.
Yeah,
we promise we talk about 3, and sometimes we do this where we promise we're going to talk about something, then we don't, and we just forget about it forever. So I want to be good to our listeners. We've got this final article from The Information. Startup employee stock sales set to surge with IPOs uncertain. We get it. IPOs are uncertain.
So Thank you, host AJ. Yes,
sorry. Shane gets so mad when I try to move us along when he's the host. By the way, we switch off being the host every other episode, and it's okay to pinch hit for each other.
And AJ always forgets who the host is.
I don't forget. I just need you to move it along. We've got 4 minutes left. Be a host, dog.
All right, you read us out. You got this article.
No, we have one more article.
You got us, host.
No, tell me about it. I'm the... Oh, boy. Here we go. Now he's going to go pout.
Right, so...
Go ahead.
There are just a quick few takeaways from this article about tender offers that we want to talk about, which are becoming a source of liquidity for a lot of the employees at the firms, because if you can't IPO, you really need some sort of secondary offering, some sort of cash out to offer to your employees. Otherwise, they feel like, all right, yeah, it's all funny money, right? But if you can offer them some liquidity earlier on, let's say 2-3 years into their employment, then they're probably going to go out to people in their network and say, hey, look, here at OpenAI, we've been fortunate enough to have a huge amount of like a much higher valuation. By the way, there's also liquidity available because we're doing, as it turns out, OpenAI does annual secondary offerings. More of this discussion around how people don't need to go IPOs to get liquidity to the employees and the owners and the investors at the company. So It turns out that company buybacks were over 30% of 2025's secondary offering. So companies such as OpenAI or other companies, corporate development or treasury departments are just buying back the shares of their own companies because they're seeing this trend upwards, up and to the right of their own shares, and they feel confident about where they're going. I think this is definitely a result of the AI bubble, perhaps. AJ, what do you think?
I agree with you. I think the point here is also that we just need more time, right? Sometimes companies, like, there is this pressure to be like, you founded a company in your basement, then you got investors, then you had a great idea, then you changed the market, and then 5 years later you're going public. And it's like, well, let's slow down a little bit. It might take a little bit more time to understand the market, have the better tech, build the tech, attract the talent that's going to build the tech that's going to be better than your competitors. So you might need more than 10 years. So to me, secondaries are a great way to buy more time, keep your employees happy because they need liquidity. They're not going to stick around if they're, in their late 30s, early 40s. Like, they want to buy the house. Like, they're going to need to take some cash out. They were promised these higher salaries. Otherwise, they're going to go to your competitors. So I think I'm very pro secondary. We do a ton of secondaries at Brooklyn FI. I think what I have learned from talking to clients and potential clients over the years is, like, the biggest regret people have is not participating in secondaries. They'll come to us, hey, my company had a secondary last year and I didn't know what to do, so I didn't participate. I have one coming up. Can you please help me figure out how much to sell and help me figure out what my tax consequence is going to be? So yeah, love secondaries. I also wanted to bring up this thing. I think it's from this other article, but speaking of, like, taking more time and, like, letting these companies marinate a little bit. I mean, tech moves so fast. Sometimes you do need to take a step back. And I don't know if you've read about this, but this Sequoia Capital Fund, they're billing it as patient capital for building enduring companies. I'm just going to read you the first paragraph because it made me laugh.
Yeah, hit me.
The creative spirits, the underdogs, the resolute, the independent thinkers, the fighters, and the true believers. This ethos describes the founders we partner with, as well as Sequoia's relentless drive to help them succeed. And then it basically just goes into this idea that the 10-year funding cycle is broken, and that's not enough time. And so this fund, they're just going out and saying, like, we're structuring it differently. There is going to be a longer tail on when you can expect a return on your capital. So we're giving people some more time, even though things feel like they're moving faster than they ever have before. So I think that's maybe part of what's happening right now, is that, like, the IPO market is blocked up so much because people just need more time, and we maybe haven't had, like, the innovation hasn't quite caught up. And hopefully in the next couple of years, we'll start to see, like, okay, now we're ready. Like, now we've had the time to build the tech. We understand that we are going to change the market, and we just need a ton of public money to make that happen. Anyway.
If I may add one quick thing,
please,
before we read out. I think there's a direct correlation between wealth inequality and the investment horizon of VC investment funds. Because what that sounds like to me is, if you don't need your investments for 15 years, like the old investment horizon was 10 years, we're going to turn this thing around and get a liquidity event. If you don't need it for 15 years, you don't need the fucking money. So, like, we have people at the very top that don't need the money. They're like, hey, why am I getting out in 10 years? Keep it rolling, baby.
Keep it going for 20 years. Well, I think
18% year over year. Like, why would I just settle for 18% when I can get 25? I don't even need the money. Like,
right. And this is only 5% of my portfolio, right? Like, that's the thing. When we talk about billionaires or multi-millionaires, they have the capacity and the ability to take these risks because, sure, I hope this investment returns 50% on what I'm putting in. And if it goes to zero, that's fine. And so I have that risk because it's only a tiny fraction of my net worth. And I know that even if I make 16 really bad investments, I'm still going to be okay. I'm still going to pass billions of dollars onto my kids. So good point. Great point.
Yeah,
Shane.
By the way, while these funds are growing in value, there's no taxation because there's no cap gains yet.
Right.
They're just invested, right? There's no dividends from these growth companies.
That's why we need a tax on unrealized capital gains for people over billion. Like, yeah, anyway. All right.
Sorry. Anyway,
the end.
A little long today, but yeah. You want to read us out?
You're the host. You're supposed to read us out. Okay, fine. Thanks so much for listening.
Read by the non-host.
guys.
Fourth wall for the listeners.
By our 200th episode, we will get this down, perhaps. Thank you so much for listening. Email us your financial problems at liquidityevent@brooklynfi.com. No one has literally ever emailed us in the history of the world except that one client that one time. We'll see you next week. You're the best. Bye.